This is Eric Thompson. I am founder and financial advisor with Peerless Wealth. We are an SEC registered investment advisory firm headquartered in Columbus, Ohio. Thank you as always for tuning in. So this one, the title is, I'll admit it, it's a little bit gloomy. The title is How to Prepare for a Lost Decade in Stocks. And I try to be a positive person and instill confidence on my clients, but we also have to be realistic. And I want to do this video to kind of help set expectations. You may have seen some of this in the financial news about how the market, which I'll define in a few minutes, is overvalued, and maybe how we're not going to get the returns that we're used to. However, there are strategies to increase the odds that my clients will get respectable returns even when the market is not. So let me start with a little bit of a story. I got my Series 7 license, which is the license that allows me to give financial advice and sell securities. That was in 1999, shortly after I graduated from college. And in 99, for those of you that remember, there was a tech boom. Anything that ended in .com, a stock that ended with .com was just going up and up and up because people were basically discovering the internet and how that would change people's lives. And anything that with a .com, all these startups got crazy valuations. And then the next 3 years, they proceeded to all crash. The NASDAQ, which a lot of these tech companies are in, went down about 70 to 80% between early 2000 and 2000 and late 2002. And the S&P 500, which is a broader index, not so much technology, but a broad index, but also it consists of a lot of those tech stocks, was down 3 years in a row, 2000, 2001, and 2002. Those are the first 3 years that I was doing my job. And the combined cumulative loss of the S&P 500 during that period was about 38%. And that was difficult for a lot of people, especially people that weren't fully diversified. And what that set us up for is the title of this video, which is a lost decade. And what a lost decade is defined as, at least in the financial press, is a 10-year period of time where the market, as measured by the S&P 500, that's what people consider the market. And this is a very important point. I'm going to get back to it. But the broad stock market, which is measured by the S&P 500, it's a 10-year stretch of time where you didn't make any money. And it started shortly after I got my Series 7 license and ended in late 2009, shortly after the financial crisis. So we went from kind of a peak in late 99, 3 down years in a row. Then we had like 6 up years and we got it all back and then some. Then the financial crisis hit. And in 2009, we bottomed out. And in that 10-year stretch of time, you could have bought the S&P 500, held it like Warren Buffett tells you to buy the S&P 500. A bunch of people in the media tell you just buy the index. Well, there was a 10-year stretch of time where you didn't make money. It was basically flat. And there's been a couple other lost decades over the last 70 or 80 years, but that one has been the most recent. And that's frustrating. And let me tell you why this is relevant right now. It's relevant because the long-term average of the S&P 500 since like the last 100 years, including the Great Depression, has been between 9 and 10% a year. Now you'll get a year where it's 25% and then down 10, but you average it all and 9 to 10 has been kind of the norm. So to have a whole decade that it's zero is pretty rare. But there are several prominent firms, including JP Morgan and Goldman Sachs, that are just put out some research that the next 10 years might be pretty rough. The last 10 years, going back from today, over the last 10 years, the S&P 500 has averaged over 13% a year. Very good, higher than average. And what that's done, especially the last couple of years, is it's elevated valuations. And the primary valuation tool that most of us in my industry use is the price earnings multiple. It's okay if stock prices go up if the earnings are going up. your valuation doesn't change because it's scaled. If you owned a rental property and it paid 10 grand a year in rents and it was worth $200,000 and your rents doubled to 20 grand a year, then maybe your price should double, right? It's scaled to the earnings, right? It's when the multiple, it's when the price goes up faster than the multiple. And we could be arguably in that environment right now. Right now, the price earnings multiple of the S&P 500 is about 24 times earnings. Historical average is about 16 times earnings. So when you're higher, you're paying more for a dollar of earnings, and that potentially means we're a little bit overvalued, a little kind of ahead of ourselves. And so to sort of drive this point home, and then I'll offer up some solutions, you're going to see a chart come up, and it's a little bit busy, and I apologize if it's a little too technical for some people, but this puts it in really good perspective. What this does, all of those blue dots are, each one of those plots is a 10-year average annual return of the S&P 500 based on a starting PE ratio. So if you start your valuations, and this is based on the last 67 years history, if we start from a low valuation, if PE ratios are 10 or 15, and you can see on the horizontal axis, there's an 11 times, a 14 times, those are low price earnings multiple environments. Those blue dots are between 10 and 20. That means the next 10 years averaged between 10 and 20% a year. That's really good. As your starting price earnings multiple increases, by the way, in 1999, when I got my Series 7 license, it was about 26, 27 times earnings. The next 10 years sucked for the S&P 500. Where are we now? This green line. This says 22 times, we're maybe 23 times now as I speak here. That means your next 10 years, you can see there when we get in higher valuation, that's when you get your lost decades, 0%, low single digits. So a little bit doom and gloom, a little bit bleak. Goldman Sachs is predicting a 3% average annual return for the S&P 500. JP Morgan between 5 and 6%, lower than the 9 and 10% that's the long-term average, certainly lower than the 13% that we're used to the last 10 years. So what's the solution? The solution is don't own all S&P 500. That's one group of stocks. During the period of time of the last lost decade, from when I got my license, from 2000 to 2010, when the S&P 500 was 0%, bonds averaged 6.3, small cap value stocks averaged 7.7, REITs, real estate investment trusts, averaged 11%, dividend focused stocks averaged 5%. And if you average all four of those non-S&P 500 categories, you get 7.5% a year average. Not great, but pretty good considering the S&P did 0 over that 10-year stretch. And so when I structure portfolios for clients, especially lately, I'm keeping this in mind. We don't want to not own the 500 largest, safest, best companies in America, but we want to be aware, at least I want to be aware of their valuations. And I want to own some things that are maybe cheaper. The small cap index is about 11 or 12 times earnings right now instead of 24, 25 times earnings. There's other options that I didn't list here, like option-based strategies that create income so you're not just relying on capital appreciation. So my solution to this for clients is to own areas that are not as expensive. And those areas haven't done as well. Small caps, real estate investment trusts, emerging markets, they don't look as good over the last 5 or 10 years as the S&P does, but I care about the next 5 or 10 years. And that's why I'm including them in the portfolio. So in conclusion, don't put everything in an S&P 500 fund. Own some of these other areas. If you're picking funds on your own or for your 401k or whatever, if you don't have me as your advisor, just keep that in mind. If you want to talk about this more, obviously call me. Set your expectations maybe a little lower over the next decade. If you set your expectations a little bit lower and you include those other classes, asset classes, your odds of participating in a lost decade go way, way down, and your odds of making a respectable return go way, way up. As always, thank you for tuning in, and we will see you next time.